Jake pays an extra $500 a month toward his mortgage principal. Marcus takes that same $500 and puts it into an index fund every month. Same income, same house, same interest rate, same neighborhood. They bought identical homes on the same street 3 years apart, and they both think they're making the smart move. They're both partly right, but neither of them ran the actual math past the surface level, and the number they're both missing is bigger than either of them expects. Here's the claim you'll hear from both sides. Pay off the mortgage and you're guaranteed a return equal to your interest rate risk-free. Or invest the difference and compound your way to a number that crushes the mortgage savings by retirement. Both arguments are real. Both arguments are also incomplete. Because the answer isn't about which strategy sounds better. It's about one variable that almost nobody accounts for when they make this choice, for the sake of honest comparison. Jake and Marcus are both 35 years old. Both earn $90,000 a year. Both carry a $300,000 mortgage at a 6.5% fixed rate with 27 years remaining. Both have $500 a month of discretionary cash after their regular mortgage payment and all expenses. The only difference is where that $500 goes. Jake sends it straight to his mortgage servicer as an extra principal payment every month. Marcus automates it into a low-cost S&P 500 index fund. Same $500, same month, same starting line. From the outside, this looks like a preference question. It isn't. It's a math question with a real answer that depends on a set of assumptions most people skip entirely. Jake's logic is straightforward. His mortgage costs him 6.5% guaranteed every year until it's gone. Every extra dollar he pays down earns him 6.5% back with zero risk, zero market exposure, zero volatility. You can't get a risk-free 6.5% anywhere else in personal finance right now. And there's an emotional component here that the spreadsheet doesn't capture. A paid-off house is a different kind of security. No payment, no bank, no foreclosure risk. That psychological weight is real, and dismissing it entirely is dishonest. On the pure numbers, Jake will pay off his mortgage roughly 8 years early by sending that extra $500 every month. That's a car, a college fund, a significant chunk of a retirement account. Here's what Jake's calculation skips. The $89,000 he saves in interest doesn't show up as $89,000 in his pocket. Because mortgage interest, up to a point, is tax deductible. If Jake itemizes his deductions, every dollar of mortgage interest he eliminates also eliminates a partial tax deduction. At a 22% federal bracket, losing $1 of deductible interest costs him roughly 22 cents. The effective rate he's actually paying on his mortgage isn't 6.5%, it's closer to 5.07%. That's still a solid guaranteed return, but it changes the comparison. And most people running this calculation don't run it this way. They see 6.5% on the paperwork and stop there. Marcus knows the stock market averages around 10% annually over long periods, closer to 7% after inflation. He's not comparing 6.5% to 10%. He's comparing 5.07% effective to 7% real. That's a 2 percentage point gap compounded over decades. Small differences at this level don't stay small. Over 27 years, $500 a month invested at 7% real returns builds to approximately $467,000 in today's purchasing power. Jake's extra payments save him $89,000 in interest over that same period. The raw gap is nearly $378,000 in Marcus's favor at retirement. But that's where most analysis stops, and stopping there is exactly where people get misled. The real picture is more complicated than that spread makes it look. Marcus's portfolio doesn't just grow. It gets taxed along the way. If Marcus is investing in a taxable brokerage account, his dividends are taxed every year, and his capital gains get taxed when he sells. Qualified dividends get favorable rates, but they still reduce compounding. A fund returning 10% gross might net him closer to 8.5% after the annual tax drag in a taxable account. At 7% real and 8.5% nominal, Marcus is still ahead. But the margin shrinks. If Marcus is using a tax-advantaged account, a Roth IRA, or a 401k, this problem largely disappears. But those accounts have contribution limits. $500 a month is $6,000 a year. That fits inside a Roth IRA for most people. If Marcus is already maxing other accounts and this $500 is going into a taxable brokerage, the tax drag is real and it belongs in the math. Here's the part that catches almost everyone off guard. The comparison only works if Marcus actually stays invested. Historically, the average individual investor in equity funds underperforms the index itself by roughly 1.5 to 2 percentage points per year. Not because the fund underperforms, because the investor panics and sells when markets drop, then buys back after the recovery. In 2008, the S&P dropped over 50%. In March 2020, it dropped 34% in 5 weeks. If Marcus watches his $200,000 portfolio fall to $100,000 and moves to cash, the math breaks completely. Jake's mortgage paydown doesn't fall in value, ever. The 6.5% guaranteed return just keeps running, quietly, every single month, regardless of what the Fed does or what happens in a congressional hearing. That behavioral advantage is worth something real, and most investing comparisons don't price it in. Now here's what the pay off your mortgage crowd doesn't want to say out loud. Paying down your mortgage is an illiquid investment. That extra equity sitting in your home cannot be spent. It can't pay a medical bill in an emergency without a refinance, a home equity loan, or selling the house entirely. Marcus, with his index fund, can liquidate in 3 business days. Jake cannot. If both of them lose their jobs at 50, Marcus can cover 6 months of expenses from his portfolio while he figures out the next move. Jake has a paid-off house and a checking account. He may need to sell or borrow against the house at exactly the worst moment. Liquidity isn't glamorous, but it has enormous practical value, especially in the decade before retirement when income is most vulnerable. Let's run the full comparison honestly. Jake pays off the mortgage 8 years early. Starting at year 19, he has no mortgage payment. He takes that freed-up cash, the full monthly payment of roughly $1,900, and starts investing it. He has 8 years left before retirement at 70. $1,900 a month for 8 years at 7% real builds to about $234,000. Add the $89,000 in interest saved. Jake's total financial gain from the strategy is roughly $323,000 in retirement wealth and a fully owned home. Marcus invests $500 a month for the full 27 years. At 7% real, that's approximately $467,000. He still carries a mortgage in retirement, but his balance at the point Jake pays off is about $180,000. He can pay it off from the portfolio if he wants to. After that payoff, Marcus still has roughly $287,000 left. His net position is slightly behind Jake in this scenario. That changes if his real return is 8% instead of 7%. At 8%, Marcus ends up ahead by nearly $90,000. The rate assumption is everything. If the market delivers 6% real over the next 27 years, paying off the mortgage probably wins. If the market delivers 8%, investing wins. Nobody knows which number is coming. That's not an evasion. That's the honest answer. The 10% historical average for U.S. equities includes the 20th century's exceptional growth period. There are serious economists who project lower returns going forward, something in the 5 to 7% range based on current valuations. If they're right, the guaranteed 5% after-tax return on the mortgage is competitive. If the historical average holds, Marcus wins by a margin that's hard to ignore. Anyone who tells you they know which scenario plays out is selling something. There's a third option that most of these comparisons skip entirely. Split the $500. $250 to extra mortgage payments, $250 to the index fund. This sounds like compromise, which in personal finance usually means suboptimal. But splitting solves a real problem. It builds equity faster without surrendering all the compounding runway on the investment side. It hedges the rate uncertainty, and it keeps some liquidity growing on the investment side while reducing the mortgage balance. Over 27 years, the split strategy lands between Jake and Marcus on pure numbers, but it may be the right answer for someone who genuinely can't decide, because the reason they can't decide is usually behavioral, not mathematical. They need both the security of paying down the debt and the growth of staying invested. A strategy they'll actually stick to beats the theoretically optimal strategy they'll abandon. Here's where your specific situation actually changes the answer. If your mortgage rate is below 4.5%, the math tilts toward investing, almost regardless of your assumptions. A 3% mortgage in a world where bonds yield 4.5% means you're borrowing cheap and can park money in nearly risk-free instruments at a spread. You'd have to be extraordinarily risk-averse to accelerate payoff at those rates. If your rate is above 7%, paying it down starts to look very attractive, because now you're competing with historical equity returns on an after-tax basis. If you carry other high-interest debt, credit cards, personal loans, anything above 8%, that gets paid first. No debate there. The mortgage question is for people who've already handled everything above it. One more thing that almost nobody factors in. If you pay off your mortgage early and later need liquidity, cash-out refinances and home equity lines come with their own interest rates. In a high-rate environment, that liquidity could cost you 7, 8, or 9%. You're effectively paying to access equity you already locked up in the house. Marcus never has that problem. His money stayed accessible the whole time. Paying off the mortgage isn't just about the rate on the mortgage itself. It's about the rate you'd pay to get that money back out if you needed it. That round-trip cost belongs in the calculation, and almost nobody puts it there. The honest conclusion isn't clean. At a 6.5% mortgage rate, both strategies are defensible. Paying off the mortgage is the lower-risk choice with a guaranteed return and an emotional payoff that has real practical value. Investing the difference wins on expected value. If you stay disciplined, use tax-advantaged accounts where possible, and the market delivers something close to its historical average. For most people in the 22% bracket with a rate above 6%, carrying an emergency fund, maxing a 401k match, and then splitting the extra cash between mortgage paydown and a Roth IRA is probably the closest thing to a correct answer. Jake and Marcus are both going to be fine. The person who ends up worse than both of them is the one who spends the $500 instead of choosing.